With the average mortgage rate moving above 8% a couple of weeks ago for the first time since 2000, many people were worried that mortgage rates were heading to 10, 12%, or even higher. I'll tell you why that's not happening and why rates are headed lower in coming months and years. The average 30-year fixed rate mortgage has been trending higher for the last 2 years. When will it end? The huge pandemic spending by the government, along with the Fed's quantitative easing and 0% Fed funds rate, spurred a massive spike in money supply and inflation, as I've described in previous videos. Now, we've seen CPI come all the way back down from the 9s to the 3s. The reason why the headline CPI number isn't at the 2% Fed target rate yet is that they used lagging shelter data averaging the rents over the last 12 months. And shelter is 43% of core CPI. If they used actual rent data instead of their lagging data, we'd already be at their target annual inflation rate, and they could stop talking about further rate increases. The last Fed hike to short-term rates was in July. So why did long-term rates move up after that, with mortgage rates making new multi-decade highs over 8%? We've had an inverted yield curve, with many people expecting the Fed to cut short-term rates starting this year, keeping long-term rates controlled by the markets significantly lower than the short-term rates, which are controlled by the Fed. However, with headline CPI still well above the Fed's 2% target, recent economic headlines make it seem like the economy is much stronger than expected, causing people to fear further rate hikes from the Fed. Most people were expecting the Fed to keep short-term rates at high levels for a lot longer than they expected in July. As I mentioned in a video interview with Karan Davis 2 weeks ago, which I'll link below, the underlying details of the recent economic reports were much weaker than the headline numbers. And we'll continue to see weakening in economic reports into next year. On Wednesday, Fed Chair Powell gave his most dovish remarks in a long time, causing long-term rates to drop quite a bit, indicating the Fed may be done raising short-term rates. And today, the October non-farm payrolls report revised the August and September jobs numbers down and also showed fewer jobs created than expected, with unemployment increasing and the smallest average wage increase in 2 years. Last month, student loan repayments resumed for many people, combining with bank tightening of credit and other factors to tighten up consumer spending and the money supply. Average mortgage rates have dropped from over 8% 2 weeks ago to 7.38% today, below the July high, and now about the same level as a year ago. The bottom line is the Fed has hiked short-term rates dramatically over the last year and a half, and long-term rates have moved up as expectations have changed to the Fed keeping short-term rates higher for longer, and supply and demand has changed in long-term treasuries as government fiscal deficits combined with quantitative tightening instead of quantitative easing has caused enormous selling of long-term treasuries, and hedge fund selling short has added to the oversupply, pushing long-term rates much higher in a relatively short period. In addition, the spread between long-term treasury rates and mortgage rates has grown to close to 3% versus the lower than 2% we've had in recent years. So when the spread drops back down to normal, that will add to the forces bringing mortgage rates down. With the fundamental shifting and annual money supply dropping, the weakening economy, with the government spending from the pandemic bills winding down, will cause inflation to drop further and will force the Fed to cut rates next year, with long-term rates dropping back down. The Fed will need to bring money supply growth back positive to the 5 to 6% level to maintain a 2% inflation level, and that will require lower interest rates. Look for mortgage rates to start trending lower in coming years, if it hasn't started to move lower already, bringing more buyers back to the housing market. Please like and subscribe for a lot more useful information to come.